Assalamu alaikum friends, welcome to lecture 7 of SBL. Today we are going to cover the approaches to governance, and under this we are going to focus on rule versus principle based approaches to corporate governance. There are two approaches to corporate governance. One is rule, one is principle based. We are going to cover both of them. Then servants Oxlay, the US Act for corporate governance, Divergent governance structure like family structure versus joint stock companies, international convergence, OECD and ICGN. So these are the 5 areas that we are going to cover today. And this is a chart. Basically, what are we going to cover in the lecture? Just a brief intro. So corporate governance, we have approaches, then we have ownership models, and we have convergence of governance code. Okay, under approaches, there are two approaches. One is rule-based, which is followed in US. The other one is principle-based, example in UK. Okay, rule-based like servants Oxlay Act, the SOX, the short form. And convergence is we have to study OECD model and the ICGN. Okay, this is there in your SBL syllabus. You need to go through this. Okay, and from your exams point of view, you will be tested in this area. Except servants Oxlay Act, that will not be tested in your SBL syllabus, but to understand how a rule-based system applies, you need to study, you need to understand how this operates. Servants Oxley Act is an example of rule based, but that will not be covered in your SBL syllabus. Okay, so you don't have to memorize anything, just understand. For understanding purpose, it is given to differentiate with the principle based. Okay, so let's start with the rule based. What is rule based? Rule based is very easy. You go by the rule or you go by the law. So you're just following the law. If you don't follow the law, you will be faced with some penalties like fine, charges, things like that. Okay, and a principle based is more open-ended. It's more broad, more general, not very specific. It does not have rules or laws to follow. It is something which is voluntarily. Okay, you want to do, you do. You don't want to do, you don't do. But again, it is not that easy. The way you think you want to do, you follow. You don't want to follow, because based approach says, okay, that if you don't comply with certain law, you have to explain. That's why there is a new thing which is added under principle base: comply with the code or explain why it has not been done so. So you have to explain. You have to give appropriate reasons why you didn't comply with certain law. Okay, that is there. So this is the basic difference between rule and principle based. Okay. Now let us go to arguments in favor of rule and against rule. So you need to understand whatever is the argument for rule will be against principle based, and whatever the argument is against rule based will be for the principle based. It's just the opposite. Okay, so when you are going to go through the arguments, there are two perspectives you have to take into consideration. One is organization, the other one is stakeholder, wider stakeholder. What do they think? Arguments in favor means they support rule based. Why do they support so? From the organization's perspective, let's see. Number one, clarity. Because it's very clear. Rules are there on the paper, you just follow. You just need to follow. You don't have to interpret anything on your own. It's not subjective, it's very objective. Evidences are there, you can check. So clarity has to be there, right? Second, standardization. Every company has to follow by the same rule. There are no differences. It's easy to compare them in that way. So organization is easy for them to prepare also, because it's standardized. Okay. Third, you are bound by the law. You have to go by the rules. Okay, if you don't, you have to give a penalty. So that shows that you will be focusing more on rule based, because you know if you don't go by the rule, you have to give penalty. Who wants to give penalty? Simply. So that's why. Coming to the arguments in favor of rule based, this is from the wider stakeholder perspective. This one was from the organization perspective. Remember the 3 points. Now again in favor, but from the stakeholder perspective. These are the same, more or less the same to organizations. Okay, greater confidence in regulatory compliance. From the stakeholder, okay, what do they think? If you go by the rule, if you are following the rule, they feel that they can have greater confidence in you, that you are going by the rules. Okay, you're complying with the regulatory systems and all. Second, again, it is standardization. That means all companies is same. So it's easy for the investors also to see where to invest. Easy for them to compare. Comparison is there. Consistency is there. And sanction. Again, because sanction is criminal, so very less likely that they will go against the rule. Okay, so it's good for the stakeholder in a way if organization is going by the rule. Coming to the against, the opposite of rule based, why they do not want, why do they not support rule based organizations. From the organization's perspective, because exploitation of loopholes are there. See, rules does not cover all the circumstances. Okay, that's why whenever rules are made, some loopholes some group of the organization or stakeholders will find. Okay, that's why laws always keep changing, because loopholes are there. Loopholes will be there. It's not an easy thing, okay, to close the loopholes. You can never, some or the other way loopholes will be there. So it's a disadvantage, right? Second, underlying belief. What is it? The belief is, okay, we always have this assumption that we always have to go by the rule. If something is not there in the rule, even if it's good for organization, you don't do that. So you go by the rule. That means you just play by the rule. You just do what the rule says. Above that, you don't do. So it's an underlying belief, which is not correct. Flexibility is not there. Remember, rules, unlike principle based, is very general, very broad. This is not flexible. Okay. So rule based does not take care into account what is your size of the organization, what is the stage of your development. Maybe you are a growth company, maybe you are a small company. So flexibility is not there. Rule based says all companies are same. All companies have to follow the same rules, whether you are big, whether you are small. For big, it's okay, it makes sense, but for small companies, it's a huge cost. It's a huge cost. They might not need all the rules. So you see, flexibility is not there. Coming to the checklist approach is there. Basically, you are just ticking the box. Nothing else you are doing. Okay. Now coming to the wider stakeholder process. Why they do not support rule based? Number one, again, regulation is overload. When too much of rules is there, it's very possible that there are volume of rules are there. Okay. So volume of rules gives you cost. Business cost increases, both for the business as well as the regulators. Second, legal cost is there. Because why? To close the loopholes, some new legislation or new rules have to be made. For that, legal cost is there. Third, limit is there. As I told you before, there is no room. No one wants to improve. They just want to stick by the rule. That's it. Minimum is that. Box ticker again. You're just box ticking. Okay? Box ticking does not lead to well-governed organization. You cannot say organization is very good by just that they have ticked all the box. So these are the few differences. Now, let us go to the Sarbanes-Oxley, the second part. Sarbanes-Oxley is a, before we understand what it is, let us go to the background of how this act has been, why this act came into the picture and when. Okay, it came in 2002. Before 2002, there was no Sarbanes-Oxley Act in US. Okay, this was made in US. It was introduced in US in 2002. Why? Because of some huge corporate scandals which happened. Examples are like Enron and WorldCom. Okay, which had lead to a massive destruction not only for the company but also for the society. The economics suffered a lot because of that collapse, because of the huge company. Also, the auditor was not allowed to practice anymore, Arthur Edison, right? So because of this, in order for them not to repeat the same mistake in the future, US, what did they do? They introduced a new corporate governance regulation, which is very tough, by the way. It's very tough, very strict, very rigid in 2002. That is known as Sarbanes-Oxley Act. So now, in today, if you want to do any business in US, you have to go by this rule. You have to follow Sarbanes-Oxley Act. You have no choice. Okay. Now let us see what it is. We'll go into detail. Before I go in detail, let me tell you, from your exams point of view, you will not be asked a question on Sarbanes-Oxley. That is number one. Number two, why I have included, why it is there in the textbook, for you to understand how rule-based is applied in real life, to understand the difference between principle-based and rule-based. Because there is no better example than Sarbanes-Oxley for a rule-based approach. That's why. And what are the things it is there? And also, if you're planning to work in US, this is very helpful. You need to know it. So in either way, even if it's not coming directly in the exam, it's helping you in a way, right? So it's a rule-based approach to governance. Number one. Number two, extremely detailed. Okay, it's very detailed, and you have to, and it's there in the law. Okay, then it includes requirements for the Securities and the Exchange Commission. Okay, to issue certain rules on corporate governance, and it is relevant to US companies as well as the directors of subsidiaries that are US listed, auditors who are working on the US listed business also. Okay, even if you are not in US, if you are a US listed business somewhere else, you still have to follow the Sarbanes-Oxley Act, the director as well as the auditor. If you are the director of a subsidiary of that US company or the auditor also, you have to follow the Sarbanes-Oxley Act. Okay, these are the 4 important points about it. Now let us go to the key points, what it covers. This is very important. This is very important. Okay, number one, internal control report. Okay, so in this ad we have internal control report. What does it say? It says that in the annual report you also have to include your internal control system, how it is it effective, it's not effective. You have to include this with the annual report. Annual report anyway, it's there annually, you have to present, right, your financial statements and everything. With that, this has to be included in the Sarbanes-Oxley, and it's a must, it's not a choice. Remember, all these things are not optional, you have to include it. Next, increase financial disclosure. So because of Sarbanes-Oxley, earlier there were not financial disclosures were not so much. That's why Enron was very easy. They easily they hide their off balance sheet financing. So now they say no, increase your financial disclosure. Okay, same financial reports to detail off balance sheet financing. Okay, your off balance sheet financing you have to include, mostly leases and everything. Your financial instruments, these things you have to include. Okay, derivatives, everything, because it's very easy to hide these things. Why? Because derivatives, options, swap, it's very easy to hide or manipulate because it's very difficult, very complex. Normally people do not understand these things, how it works and operates. So it's easy. Even if you include also, people will not understand. That's why you need to include detail of balance sheet financing, financial instruments, leases, right? Restrictions on dealing, what is it? Directors cannot hold shares at sensitive times. There are some sensitive times in a company where directors are prohibited. They should be prohibited from dealing with any shares. Why? Because if the directors deal with any shares, they will be having some financial interest in a company. Okay, so restrict. It's not good for the long term health of the organization. Audit partner has to be changed every 5 years. The senior partner every 5 years, so that familiarity thread is reduced. They do not become too familiar with the organization. That's why every 5 years change. Auditor independence. Remember, in UK, under corporate governance code, things might be little different than this. Sarbanes-Oxley, it might be not so strict like this. Okay, maybe here audit partner you have to change every 5 years. Maybe under UK corporate governance code, year might be different. Okay, so auditor independence. Auditor cannot give additional services other than audit to the audit client. Yes, you can give additional services, but it has to be done by some other partners. Okay, not the auditors. They cannot give non-audit services to the audit client. Okay, audit committee. Every company have to have an audit committee. If you do not have, you'll be disallowed from trading. Remember that. And accuracy of financial statements, it has to be very accurate. How do you know it's accurate or not? Make it checked by CEO and the CFO, the chief executive officer and the chief financial officer. They have to monitor it. Okay, so these are some key points. Now, with that understanding, let us go to the key effects. Because of Sarbanes-Oxley Act, what is the effect that it had on the companies? Let us see the key effect, the very important, significant effects. Okay, number one, because of this, now directors are personally liable. If they have done any mismanagement, they are personally liable for it, and there'll be punishment for it. They are the one who will be accountable. They'll be held accountable for it. Second, communication has improved because material issues are now disclosed to shareholders. Before things become worse, disclose it beforehand to shareholders so that they are aware of what's happening, right? Improve investor and public confidence also. Remember when this happened, Enron collapse happened, public lost their confidence in the auditors, right? So now, because of this, now they are gaining that confidence back because of the Sarbanes-Oxley Act. Improve internal control and external audit of companies. Yes, your internal control will be better. External audit is also happening in a better way because of Sarbanes-Oxley Act. Greater arm's length transaction between companies and audit firms. Arm's length transaction means which is happening in the normal market. Okay, it is not something. See, a transaction which happens because of your close relationship with someone, maybe because you're a friend or someone. Okay, uh, let's say you are giving a gift to someone, or maybe you're selling an item to your friend or someone, you'll be giving them obviously at a lower price than the market price. So that is not an arm's length transaction. Arm's length transaction means which is fair, which if you sell it in the outside market, whatever the price, that is known as arm's length transaction, not because of some close relationships or anything. So arm's length relationship, great arm's length relationship now between the companies and the audit firms. And improve governance through audit committees. When audit committees are there on the board, your governance will improve. Because remember, at the end of the day, why are we studying all this service oxide everything? Main thing is corporate governance, to improve the corporate governance of the company. That is it. Now, it's not only positive. These are some positive effect it had. Now we have some negative effects also of this, because everything has a positive and a negative. Okay, negative side is audit fee, doubling of audit fee, in fact, because you have to hire the audit committee has to be there, you have to check the auditor's independence, so audit fee improved, doubled. It's cost, no? Second, too much of documentation and internal control cost is also there. Third, flexibility is reduced now. Every organization, every company has to go by the rule. So where's the flexibility? Reduce risk taking and competitiveness of organization. Remember, because now organizations, they are so much accountable, flexibility is reduced, criminal sanction is there. What will they do as a result? They will not take so much of risk. Even if it's good for the organization, even if shareholders' wealth will increase, they will not take that project. So they will reduce their risk taking. Okay. Limited impact on the ability to stop corporate abuse. Remember, even if Sarbanes-Oxley Act is just a way to reduce the corporate abuse, but it will not reduce it to zero. Ultimately, it will not reduce it. Still, there will be something. Some loopholes will be there in the organization. So, limited impact is only there, not so much. Still, corporate abuse will take place. Okay. Legislation. Okay, see, legislation rule. Whenever rule is there, it's just a minimum standard that an organization needs to follow, or maybe a little more. But that does not mean that that's it. Okay, that's not the best practice, you can say. Now, third topic is divergent governance. So from Sarbanes-Oxley, we are moving towards divergent governance. What is the meaning of divergent? Meaning different, two different ways. Convergent means same, you're coming to same common idea or common objective. Divergent means you're going two different ways. So understand the difference first. So divergent governance means governance might be different, maybe because of so many factors. We'll see what are those factors. This is very important from your exams point of view because question has been asked on this area. Okay. So corporate governance is not same from organization to organization. Remember, the way you do the actions that you have to do differs based on organization structure. What is your organization structure? NGOs will have a different governance thing, corporate governance. Smaller limited companies will have a different set of corporate governance. Then US companies, we just went through Sarbanes-Oxley, that is rule-based. We just finished. Private or family companies will have a different set. Global organizations will have this one. Okay, which we are going to cover. So the private and family companies and global organization, the last two things we are going to cover. Okay, in just few minutes. Let us first touch on NGOs. Okay, so NGOs is very similar to the public sector. Okay, we still haven't covered the corporate governance for public sector. That will be my last lecture under corporate governance. Okay, because in your syllabus it is given in the last, so I'm following the syllabus only. If you have the SBL syllabus, you will see that it's number 6. It comes under number 6 under your section B of your corporate governance. That's why I will include it in part 6, last lecture. So that's why I have not covered it yet. Okay, but NGO is very similar to that. Governance issues, whatever the governance issues is there for public sector is same for NGOs. Okay, why? Because they both have same motive. They are both not for profit. That's why. Okay, but they have some problems also, because it's not for profit, things are more difficult. To control corporate governance in an organization which is not for profit is more difficult, remember. Okay, why? We'll see that. So because of that, there is a need, okay, that everyone wants to commercialize now all the operations, whether it's NGOs, public sector, right? What do they want? They need to run the charity as a business. Why? For the benefit of all. Ultimately, you need money to run the charity. You just cannot run everything on charity, and you need some fund to run it. So to need fund to run the charity, you need to run it as a business. Okay? Why you want to move to a more commercially run operation like this? Why? Reasons is number one, because if you do that, you will be using the resources more efficiently. Okay, more resources will be used more efficiently by the stakeholders. Second, you need to get the most out of the budget or the gift or the grant that is given to you in the service provision by moving from charity to business. Number three, the directors. Okay, the increased use of directors from the private sector to run not for profit organization. Okay, nowadays what's happening, most of the people who are working in not for profit organization are from the private sector only. You're pulling them off because they have a better understanding of running it in a more effective, efficient, and a economic way. Then, increased awareness and skills among employees. See, when you come from private sector to NGO, you will have a better understanding. Employees there have a better understanding, skills on how to run a business. Because running a business and running a charity is two different things. You need skills to run a business. So when you come to charity, this will be very helpful. Okay. Next. But what's happening because of the shift from business to NGO? It's a cost, remember. Okay, because of this your accountability is increasing. Okay, performance also will be improved, but it has a cost. Everything has a cost. And also there's a culture clash. Why? See, why are you running an NGO? What is your main idea? Is it profit? No, it's not for profit. It is for some serving social need, but you are running it as a business. So you see, there are two things. Your objective is to run it as a social need, but you are running it as a business, so this leads to some dilution. Okay, leads to some conflict. So boards are councils or governing bodies. The boards that are there, they are the councils or the governing bodies. Managers are the administrator or the organizer, and the board, they struggle to find a method or a function. Okay, because it might not go with their philosophy or their configuration. You see, so these are some governance issues. It's hard. Cultural clash is there. What is the key reasons for these differences? Dominant or silent patron. The anti-industry bias or culture is there. Okay, every industry has some culture in it. Okay, and they'll be biased towards that. They'll be following one specific culture and they will stick to it. For example, NGOs have their own thing, businesses will have their own thing. So when the two meets together, clashes is there. Discretionary nature of the sector. Remember, NGOs, you are using volunteers. Okay, something which you want to do, you do. It's your own will. You don't have any obligation that you have to run it, nothing like that. So, and volunteers, their objective might be different. Not every volunteers will have the same objective. Again, there's a clash. Ambiguity of mission and commercial imperative. Mission is not very clear. Unlike profit sector, where you know you have to make a profit, increase your sales in 5 years, market share, things like that. Historical mode of custom, yes, maybe the history, the way you have operated, the custom that you have followed might prevent you from performing better, right? Maybe in the history you have been operating as a business, and now when you're coming to NGO, things might be different. Lack of commercial skills in senior management. Senior management might not have the commercial skills to run the NGO. So these things might lead to corporate governance issues, problems in the corporate governance. And also unwillingness of directors to move beyond their parental devotional view. Sometimes what happens, the directors, they do not move beyond that level. They stick to that thing in the NGOs. Now let us go to from smaller limited companies from NGOs. Okay, here remember there is a duty in all organizations. Okay, when it comes to law, whatever the size is, that you have to produce audited accounts. Okay, whatever the size you are, you have a duty. Whether you produce or not is up. It's another thing, but duty is there. Okay. Second, but even if small and limited companies do not produce audited accounts, still there is not an issue. Why? Because when you come in governance term, from the governance point of view, agency problem is not there in the small and limited companies or the private limited companies. Why? Because the shareholders are the one who is running and who is controlling the company. They know what's happening there. They are directly involved in running of the company. They are not hiring any agent or someone. Okay. So because of that, agency problem will not arise. You understanding? So even if they give audited accounts or not, it's okay. And also there is a general perception that all companies should comply, whether it's small, whether it's big. Okay. Why? So that communication is improved. Okay. So either they should comply or they should explain. This is same for small limited companies also. Okay. So perception is there, whether it's small or big, every companies comply with the law. That is there. You cannot say this is small, so they will not comply with the law. Do we say like no? Everyone. So that thing is there. Now, but because of their size, problems arise. What are the problems? Number one, role and number of NADs. See, big companies, what do they say? At least half of your board should be with independent non-executive director. That is 50%. 50% executive, 50% non-executive directors. Okay. And their role also is very massive in a big organization. But when you are coming to the small limited company or the private company, is very difficult. It's very difficult to have 50%. Even if they have, their roles are very limited because it's a small organization. What is there so much to check? You are the one who is running, so it's very limited. Okay. Second, size of the board. Board is also very small. Also, if you see, most of the shareholders might be your family members only. Then audit and nomination, there might not be any nomination committee. You only hire or fire based on whom you know, your contact and everything. And audit also, you don't use an audit committee because you don't need to, right? So these are issues, these are problems later on. Okay, this comes with the size. Okay, remember the three problems, but you have to know these problems. Okay, because in the exam, in your SBL exam, you don't know what type of organization you are given. It could be NGO, it could be public sector, it could be private sector, it could be small company, big company, anything. We prepare for everything. Okay, whatever it comes, only one company only will come throughout the whole case study, SBL. Okay. Now, so coming to the governance structure. Okay, the way governance structure will be, it depends on how you are owned, what is the ownership of the company, or who has the power, or who has the control. Okay. So this is just an illustration to understand. Okay. So Laporte in 1999, they analyzed the company structure that 49 countries, okay, in 49 countries, only 25% of large companies have wide share ownership compared to 35% of being family controlled. Okay, that means more are towards family control than having large companies. Large companies means they'll be having wide share ownership. There are many shareholders who are not family people. But family control means shareholders are very less. They are family only. Example like Walmart, Barclay, or Cadbury. These are family control business. Okay. So in this things, what happens? Family is the one who is controlling. They are having the control. Okay. Second, they are participating in the management also of the company. And third, other large shareholders, they are not there to monitor the controlling shareholders. Controlling shareholders means the family who is controlling. They are known as controlling shareholders. So other large shareholders, they are not controlling them. So these are the three things which comes when it's a family business. Okay. This is just an example to understand. Companies like Walmart is also family business, Barclays is a family, Cadbury is a family business. So they'll be having this structure. Based on your structure, your corporate governance will change. Remember. So now let us come to that. Family structure versus joint stock companies. Joint stock companies, we know, limited companies where you hire an agent, directors are there, CEO is there, then middle manager is there, employees are there. They have to give a report to the shareholder at AGM, they come, all those things. Family structure is not like that. Okay. Family structure, the shareholders are very less. Maybe 2, 3 shareholders are there, but they'll be having a big shares, okay? 30%, 40%, or maybe 50-50 among you and your brother, things like that. So what are the benefits of family businesses? Family structure companies. Number one, this things you have to know by the way, because in the exam also directly they can ask you like this: what are the advantages or what are the disadvantages? They can ask. They have asked. Okay. So agency cost is less as I told you because family is involved. They are not hiring any agent, so agency cost is less. Second advantage is ethics, because if anything happens to the organization, it affects your family honor. Remember, so you will do everything to protect it. That means you'll be very ethical. Okay. Third, short-term decision, fewer short-term decisions. Whatever you do, family, they always think for the long term. Okay, because they want to give this family business to their children, their grandchildren, right? They'll be inheriting it. So they think long term. Okay. So these are the three advantages. Coming to the disadvantages, problems. Gene pool, what is it? See, the gene pool that is there, okay, it is the same people. Okay. So when it is the same family, see, family is more or less they'll be having similar talent or things like that because they are exposed to similar environment, same environment. Everyone thinks alike. Their taste, their talent is very much similar, not so different. Okay, so over the generations, this is very questionable. Maybe it might not work. Maybe it worked 10 years back. Maybe something worked for your father or grandfather's generation. Maybe this talent or this expertise might not work for your generation. So because of that, this is a disadvantage. Okay, you need to bring out some people, fresh things might, fresh idea must come out from outside the family. So this is a disadvantage. Feuds, families fight. Okay, no families operate without fighting. You must be knowing this very well. If you run a family business, what happens? Okay, that's why there's a saying that you must never do business with a friend or a family. Okay, so because of this, it affects your business. Okay, then separation is there. Okay, when families separate, it's very hard because in terms of buying out the shares and restructuring is very difficult. Okay, now insider versus outsider. Okay, insider dominated or outsider. Insider is very much like what we have just covered. Family and outsider dominated means limited companies, listed companies. Okay, examples are there. So insider dominated are listed companies are dominated. See, both are listed. whether insider or outsider. But insider is dominated by small group of shareholder. Inside shareholders. They are very inside. Okay, small group of shareholders. Outsider dominated means still they are listed companies, but large group of shareholders. Understand the difference first. Okay, so inside is very much like family owned. Family owned is a listed company, but shareholders are very small. It could be banks or other companies or governments, or and this nature is mostly followed in Japan and Germany. They are very family owned business in Germany and Japan. Okay, you can even research more if you want to have a better understanding. So this has some advantages, this insider dominator structure. Let us see what are the benefits. Number one, agency problem is reduced. Same like what you have covered in family business. Agency problem is reduced. Okay, so owners and managers very easy to establish the links. Second, greater access is there, and cost of capital also will be lower. Why? Because shareholders are very small, no? Smaller base of shareholders are there. Third, smaller base of shareholders are willing to take long strategic view of investment. Remember, when people are less, it's very easy to take a decision for the long term. Okay, because you have to convince less people. Whereas if it was 10, 20, 30 or 100 shareholders, it's very difficult to convince all and to think from the long term view. So lesser the people, lesser the shareholder, better it is for the long term view. Okay, and communication is improved because less people, easy to control, easy to communicate. Okay, so you can easily influence. Coming to the problems, there minority shareholders are there, but they are not protected. There is a lack of minority shareholder, but in outsider they do have a control. Okay, because law says so that shareholders has to be protected. There's a shareholder right, but in the family business it's not like that. Transactions, operations are very opaque. Opaque means it's not, see, transparent means you can see through, you can see what is inside. Opaque is not transparent, you don't know what's there. So it's very easy to manipulate or hide things like that. Because of family business, you might not have non-executive director, you might not have a personal outside, your family is the one who is auditing or they are the one who is checking. So operations are not very much transparent. Okay, reporting is also not so transparent. Power can be misused. Okay, you might be reluctant to employ someone from outside, like non-executive director, because obviously family owned business, they do not want someone outsider to come and influence you. Okay, it's very common. Then here market does not decide or govern. So because of that, it's a family business. If things go wrong, you cannot easily just exit. Okay, even if you're unhappy, you cannot easily exit. It's your business. You exit out the business means you die. Okay, then you are very reluctant to develop formal governance structure. Why? You feel you should not be accountable to anyone, you feel you should not employ non-executive director, you feel there should be no audit committee, because it's your business, no? You know what's happening, you know, so you are very reluctant, which are problem from the governance issue. And reluctance of large independent shareholders to invest. Even large independent shareholders, they do not want to invest, they rarely invest in family business, they do not, so because they know the mindset of the family business. People who run family business, they're very reluctant, they do not cooperate well with the other shareholders. Coming to the national differences. Okay, governance structure could be different because of national differences also, because every country operates in a different way. Okay, so this insider, whether you are going to be a family business, whether you're going to have many shareholders, depends on your national differences, which country you are. Okay, second, also the legal system of the country also will influence what type of system you will go by, and also the degree of recourse. If there's a little recourse, it will be an insider dominated. If it's more, it will be outside dominated. Okay, insider orientation, like France. Okay, countries in France, they are very family oriented. Okay, see, if in case you forget, okay, it's very easy. Family stands for F, French is also for F, so FF. Okay, French. Okay, French structure because of its origin. They are like that. They started like that, and they follow that trend. Outside orientation is more like Anglo-American, like US. They are very outside orientation. They are major. They are not so family-oriented business. They have many shareholders and things like that. Okay, because it's their origin. They originated like that. Understanding? So the structure is developed based on what is your legal system or what is your national differences are there, right? Origin. So because of that, it helps you to decide whether you will be an insider or an outsider. Okay. Now, corporate governance and the European Union. Let's see. Okay. This is again for pure understanding, nothing to memorize, and it will not come in your exam also. Don't worry. But I felt it's very relevant for me to explain this. Okay. So in May 2003, what happened? The EU Commission, they presented a communication entitled, okay, the name was Action Plan on Modernizing Company Law. So they were modernizing the company law and they are enhancing the corporate governance in European Union. What is the action plan to modernize that? That is what is there in that communication. Okay. So the aim of the report is mainly to harmonize the corporate governance framework. That means so that all the member states in European Union, are they follow the corporate governance framework and it's very consistent among the European Union states. That is the main idea. Okay. And what are the recommendations in this report? They say that listed companies, they should publish an annual statement on corporate governance. This is for all EU companies, okay? All the companies that are there in the EU states, European Union, they all have to publish annual statement with the corporate governance. That is what they have told in this report. Also including a comply or explain regulation. They have to comply or explain. Next, board responsibilities, collective board responsibilities. Okay, it's the responsibilities of the board to disclose financial and non-financial information. Okay, you don't have to go in depth in what is EU derivative and the details and all things is not required. Now, but on 5th April 2011, what happened? EU Commission, they launched a public consultation. What was it regarding? How to improve the existing corporate governance. Okay, so the main idea, objective of the green paper is what? They were debating on issues, okay, on the field of corporate governance, on how to improve it better and better. Okay, but they have amended, okay, the new EU derivatives, or they might have amended the existing derivatives. Okay, so when they do that, remember this will be incorporated in their national law also of all the member states of EU, because every member states in EU might be having little difference in their national law, if not very similar. So this EU derivatives, when they amend, they have to take care of the national law and then see. They have to incorporate the national law also. Now, corporate governance in Commonwealth countries. So we are moving from EU to Commonwealth countries. Okay. So here, what is their concern? Is to establish good corporate governance. Okay. And it began first in Hong Kong. Sorry, in South Africa. Okay, it is known as King Report, and it was first began in South Africa in 1994. Okay. Then, so in this Commonwealth countries, okay, remember there are many emerging economies also. One such country is South Africa. Okay, because it was having a developing stock markets. So here, whenever a country where it is having a developing stock markets or it's developed, it's very important that your corporate governance has to be very strong, because without that, stock market will not operate. So that's why having good corporate governance was seen very essential there in South Africa that time. That's why this King report was introduced. In the King report, all the corporate governance things is there. Okay. Next. So the work of the first King report. What happened in the first King report? Because of that, in 1998, they set up CACG, that is Commonwealth Association for Corporate Governance. All these things, detail you don't have to know, it will not be asked. I'm just explaining you how it's set up and things like in different countries how corporate governance is working other than UK. And in 1999, it's produced a set of corporate governance guidelines. Just a year after that. And here, what did CACG did? They have put a list of 15 principles of corporate governance. 15. You don't have to know the 15 points. It's okay. And this 15 points, they are very similar to other corporate governance guidelines also for other countries. Okay. Okay, so when you are viewing these 15 principles, you can go and Google and check what are these 15 principles in CACG. If you're going through that, you have to see this from the viewpoint of emerging market. The markets just are just emerging, just developing. They have not yet developed like UK and US. They're developing countries. So from their point of view, what could be their corporate governance? You have to view like that when you're reading the 15 principles. Now let us come to Japan because we are talking about national differences. So we'll be talking about different countries, how corporate governance is different. In Japan, what happened? In 2003, they introduced Japanese Commercial Code. It is known as Japanese Commercial Code. Not every country will say corporate governance code, corporate governance code. Term might be different, but the meaning is same. Okay, in UK, we have UK Combined Code or UK Corporate Governance Code. But in Japan, it is known as Japanese Commercial Code. Okay, so here they have included provisions like US style board committees. Very similar to the board committees that is in US, they want to follow in Japan also. But what happened in Japan? In Japan listed companies, they are not yet ready to adopt this new system. Many listed companies were not yet ready. Okay. This is just to explain you the commercial differences, the national differences that I've included these examples. From the exam point of view, it's not relevant. Now coming to the international convergence. I think this is the last topic out of the 5 points that we were going to focus. So in international convergence, we are going to study 2 things, OECD and ICGN. It is there in your syllabus, you need to go through this. 2 things you need to go through. Okay, international convergence means, see, internationally in every national country, different countries, laws might be different, corporate governance system might be different. Now what are they doing? They feel that it's better to make them more uniform so that practices are very consistent, because now what's happening, world is no longer any more different markets. Now everyone is becoming one single market because investors are investing in many different countries. So they want the practices to be more harmonized. So harmonization and liberalization of financial markets have led this. Okay, because of this liberalization, now it's very free. You can invest in any marketplace from anywhere, any country. Okay, so because of that, it's very important that we become convergent. Convergent means we become one. Our auditing standard, accounting standard, corporate governance becomes one. You understanding? That is known as convergence. Why international? Because international practice. Okay, so because of this, all the international standards, okay, they are driving towards international standards, so that whether you're in UK, whether in US, whatever country you are just following by one rule or one set of standard internationally. What the good thing is, it's very easy for people to compare. Practices are consistent. You just need to know one set of rules and that's it. Okay, in IAS it happened, international accounting standard, this practice happened, convergence could be seen, but corporate governance will see how it has converted or not. Okay, one example is international accounting standard. It has become more harmonized and it has become more convergent. Now there are 2 organizations that have published corporate governance code. Okay, when they published this, their intention was to so that this code could be applied anywhere in any country, multiple national jurisdictions, multiple. These 2 organizations, I think you know it. One is OECD, the other one is ICGN. OECD is Organization for Economic Cooperation Development and ICGN is the International Corporate Governance Network. These are the 2 organizations. And we have to know those 2 things, by the way. Okay, let us first start with OECD. Okay, let us go through a background of this. Little bit background is not important for your exam. Understand how it came to the picture before we know what that includes. This was established in 1961. Okay, so in this organization, all the industrialized market economy is there. Okay, all the industrialized market economy countries is there, and it includes developing countries also. Industrialized market economy countries means developed countries, US, UK. It includes developing countries also. Okay, and it provides a forum. So in this forum, what do? They establish and coordinate policies. What is best for each country? What is best for the economy? What is best for the development? They establish as a forum, like, where they meet and they develop policies. And in 2004, these principles were updated and republished again. Because I told you, every time principles, they need to be published, updated. Okay. Now, what are the objectives? This, from here, things is very important that you need to know. What are the objectives of the OECD principles? Number one. Okay, so the principles, whatever the principles is there, what do they represent? They represent what was the first initiative by the intergovernmental organization. The main initiative is to develop the good corporate governance. What are the elements of the good corporate governance regime? That's what they wanted to develop. Second objective is, okay, what are the principles? It is to assist the OECD or non-OECD governments also, okay, to improve their legal, their regulatory framework for corporate governance, okay, in their countries, and also to provide guidance also on the stock exchanges for the investors, for the corporations and other parties, okay. They give guidance also to other stakeholders in the process of developing good corporate governance and how they can develop good corporate governance. Okay, remember, every party or every stakeholder has a role in developing good corporate governance. It's not just for the company or for the government to do it. Every stakeholder, whether you are an investor, whether you're in the stock exchange, whether you're the government, whether you're the employee, you have a role in developing good corporate governance. And how do you do that? You go by the principles of OECD. It guides you. So that guidance is also there in OECD. Third objective. Okay. It represents a common basis. Okay. That all the OECD member countries, they consider that is essential for the development of good governance practice, that is there. What do they consider essential for good corporate governance practice is there. Principles represent that. Fourth, whatever the principles, it mainly focuses on what? Publicly traded companies, whether financial, whether non-financial, both financial and non-financial. Okay. Okay, wherever it could be applicable. Okay, it might be useful for non-traded companies also. I'm talking from the point of corporate governance only. In terms of improving corporate governance for non-traded companies also, you can take the objectives of the principles of OECD. Things like privately held or state-owned enterprises, like public sectors and all. Not totally, but wherever it is applicable. But mostly it is for publicly traded companies. These OECD principles are. Fifth objective. The principles that is there are very very concise, that means very brief, you can understand, and it is accessible to international community. All the international community can easily access them. Okay, and the last is, remember, this principle, they are not substitute for the government or the semi-government or the private sector initiative. Okay, because what happens, government or private sector, they might have their initiative to develop best practice in corporate governance. Okay, they might be having their best practice in corporate governance. For example, you working in a private sector, you might come up with your own best practice in corporate governance, but that should not be the substitute for this OECD principles. You cannot use it as a substitute. You still have to comply with these principles, OECD, even if you have the best practice in corporate governance in place. Coming to the content of the OECD principles. Okay, what are the content? It gives the basis for an effective what? It ensures the basis for an effective corporate governance framework. Basis. It makes the basis very strong. Second, rights of the shareholder and key ownership functions. Third, all the shareholders should be treated equally. Fourth, what is the role of the stakeholders in the corporate governance? What is the importance of disclosure and transparency? Responsibilities of the board. Okay, go through this content. This content is very important. Content is very important, in fact. Okay, principles I would not say so important because it will not be asked like that. Basically, what it says in the principles is about corporate governance only. Okay, everything in short. But principles, you have to go through these principles. Principle is very important, whether it's for OECD, whether it is for ICGN. Coming to the ICGN. This was founded in 1995. Okay, all the major institution investors get along. Okay, so their intention was to represent investors, companies, financial entities like banks and things. Okay, and all the parties who are interested in corporate governance. So they wanted to develop an effective global practice and standard in this field. Okay, this and OECD is different. Okay, similar also, it has differences also. They're not the same thing. What are the objectives? Okay, here also they highlight corporate governance element only when making asset allocations and investment decisions. Second, here they focus mainly on what? Where securities are traded in the market. Very similar to that. Publicly traded companies. Very similar to OECD. Here also, some principles might be applicable for privately held companies also. Then, here they encourage the jurisdictions to address certain broader corporate and regulatory policies. Okay, what do? The ICGN principle says sometimes they encourages you to go beyond the authority of the corporation. Maybe your authority is up to a certain level. Go beyond that and follow the rules so that you have a good corporate governance in place. Okay, next. ICGN principles, they are drafted to be compatible with other recognized code. There are so many other recognized code of corporate governance. ICGN principles, what do? They want them to be compatible with other codes also. But in some instances, they might not be compatible. They might be very rigorous. They might be very fixed. They might not be very flexible. Okay, and ICGN, like OECD, they include all the party. They include the role of the stakeholders in the corporate governance. Basically, they feel everyone is important. So they feel that to improve the governance should be the objective of all the participants in the corporate governance process, whether investor, whether board of director, whether corporate officer, whether stakeholder, as well as the regulators also. So ICGN, they address the principles to all participants, not just to the shareholder, all the participants. It is very similar to OECD principles if you see. Only the wordings are changed. Here, let us go to the content. Remember, content is very important, whether it is for OECD, whether it is for ICGN. Content is very important because on this area only you will be asked in the exam. Not exactly, they will not ask you what is the content. No. They will give you some case study. They will tell you what is the impact of this. And then you might have to use those principles. Corporate objective. Okay. Shareholder return. Disclosure and transparency, similar to OECD. Audit. Audit was not there in OECD. Then shareholder ownership responsibilities, voting remedies. Corporate boards. Corporate remuneration policies. Corporate citizenship, stakeholder relations, and ethical conduct of business. If you see, this is more like ethical and talking about CSR, corporate social responsibility, which is not there in OECD. Okay, because they talked about corporate citizenship. We covered these things in the previous lecture. What is corporate citizenship? What is the stakeholder relations? What is ethics? We covered all those things. And why corporate remuneration policy? Because remuneration is very important when it comes to corporate governance. Remember, earlier business collapsed because access remuneration was given to executive board. Access, it should not be excess, it should not be too low, it should be just reasonable, right, to the job that you are doing, to the position that you're hiring, things like that. Corporate board has to be structured. They should have non-executive director, diversity has to be there, things like that. So these things are important from the point of corporate governance. We covered in fact many of these things in our earlier lectures, right? And if you see, some of this were not there in OECD, so additional things are there in ICGM. Then corporate governance implementation, how you implement corporate governance is also there. Okay, like any other thing, this again has some limitations. There are two limitations. Number one, they are voluntarily. Again, they are code. These codes are principle. I told you, they are not servants Oxlay. They are not rule. They are voluntarily. Whether OECD principles, whether ICGN principles, they are principles. They are not rules. So they are voluntary. You cannot legally enforce them. When someone does not follow, you cannot fine them. You cannot say you will be held accountable. No, unless it is there in the rule, in the law of the individual countries. The law says so. Second, local differences again. No matter however you try to bring everything into one, that all the countries need to follow one certain set of principles. Again, there are some local differences. Because of that, it's very difficult to just imply one set of principles for every country. Because every company, the ownership is different. Some may be family, some may be outsider. So part of the codes are not applicable. Maybe some part of the codes you can apply, some part of the code ICGM principles you cannot apply. So again, ICGM principles also has its limitations. So that's it. Now let us summarize everything whatever we have included in this lecture. Okay. So first, under corporate governance, we went through the approaches. There are two approaches, principle and rule based. Under rule based, we went through Servants Oxlay. Okay. So rule based, prescribed set of requirements is their rules. Second, you can bring any organization into line very quickly, whether they go by the rule or not. Yes or no. It's like yes or no thing. Checklist approach, and discretion is reduced. Okay. It's not voluntarily. You have to. So you don't have a choice. You don't have an option. Inflexible ways. Okay. It's very inflexible compared to principle based. You don't have to interpret. Okay. It's very clear. And same rules apply to all companies. Then under principle based, okay, very broad. Okay. There are principles that are set out in the code. Okay. Second, it's not like tick in the box like rule based. Then it's very broad. It's not narrow like rule based. It can be interpreted. Okay. When interpretation is there, different persons interpret principles in a different way. And best interest of the company should be considered. When you are going by the principle based, you go by what is best for your company. If you feel this is best, you go. If you feel that is best, you go by that. Not like rule based. Rule based, you're not that flexible. Whether it's good or not, you go by the rule only. So on rule based example is, and also is flexible principle based. Rule based example is US Servants Oxlay Act. What are the key points under this? And what are the key points under UK Combined Code? Example of principle based is UK Combined Code. So in US Servants Oxlay, auditor independence. How do you check whether auditors are independent or not? Change the senior audit partner every 5 years. Audit committees, you need to set up, otherwise you cannot trade. Audit partner again needs to change. And they cannot give non-audit services to the audit client. Okay. Restrictions on dealing. Directors are prohibited to deal in shares at certain sensitive times. Internal control report has to be given alongside the annual report. Increase financial disclosure regarding off-balance sheet financing. Accuracy of financial statements, you have to make sure that it is checked by CEO and the CFO. UK Combined Code, it is a code of best practice. What you consider as a best, okay? It still has room for improvement and things like that. It is incorporated in listing rules. What does it mean? When a private company want to get listed on the stock exchange, you have to follow the UK Combined Code. Because if you don't, you will not be listed. Remember. So it's a rule. You need it. Listed companies, okay, you are required to comply or explain. You either comply with the rules, with the principles. If you don't, you explain why you have departed from that. Okay, so that flexibility is there. Now, then we went through impact of ownership models. Okay, Balance of ownership and control, that means family versus outsider shareholders. Number of shareholders, small or big. Business risk and therefore CG means corporate governance, okay? Business risk and therefore CG focus will differ. So because of these differences in the ownership, whether you're a family business or you're not a family business, your business risk will change. It will be different. Your corporate governance issues also will be different. Then we went to the governance code, okay, which could be applied in multiple jurisdictions. One is OECD, the other one is ICG, and both are principles. Principles means they are principle based. Rule based is only US Servants Oxlay Act. Other everything whatever we have covered is principles. Okay, so US Servants Oxlay Act, no need to memorize, but just go through the key points. That's enough, more than enough. And UK Combined Code also not so much to go through, but OECD principles and ICGN principles go through the content of both and the limitations also. So that's it, and thank you for watching and see you in the next lecture. Till then, take care.